Hi there and welcome. My name is Mike Larson and I'm the editor-in-chief at The Money Show. Today I have the privilege of speaking with Stephen Schork of the Shork Group. Stephen founded the group and he is the energy industry's foremost provider of price range forecasting and objective analysis of the energy markets. Stephen has extensive experience in structuring and reviewing purchasing strategies, preparing narratives for presentations to boards of directors and investors to support trading and hedging decisions. He also provides cost-benefit analysis of mergers, acquisitions, and construction of new assets, and designs customized engagements tailored to clients' business objectives. Quite the bio, though, Steve. You're obviously an expert in the energy field, and welcome very much to this interview today.
It's great to be here, Mike. Thank you.
All right, Stephen, let's start with the big picture. Where do you think we are when it comes to oil and refined product supply and demand? I mean, there's so many moving parts out there with the ongoing war in Ukraine, the worries on the economic front, the Fed's going to drive us into recession. So let's start there and then we'll drill down from, if you don't mind the pun.
Yeah, no, absolutely. So what we're looking at is an industry that really took it on the chin. That is the oil and gas industry during 2020, losing the top five private companies, losing about $70 billion as the economy around the globe was shuttered. The industry has since rebounded, but it's learned its lessons. It went in full force with the shale gale in 2009. And when we really ramped up with the Great Recession, demand dropped off and the industry, again, took it on the chin. Then they came back and they came on full hog in 2012, 2013, and once again in 2014, when Saudi Arabia and OPEC decided to tank the market and put oil on the market. Once again, North American producers were left holding the bag, and we saw a number of bankruptcies going through the industry. So now that we come out of COVID mitigation, again, $70 billion loss in 2020, the oil industry has finally learned its lesson. More importantly, the banks, the people with the liquidity who are lending the money, they've really pulled in the reins. And therefore, U.S. production has dropped from, well, we were the leading global producer of crude oil. The country, United States, was the largest crude oil producer in the world. We were energy independent with regard to all of our needs at this point. And we were producing well over 13 million barrels a day. But the industry, because what? We came out, it was declared in the summer of 2021 that COVID was over. But what happened in 2021 over the summer? We were introduced to a Greek alphabet soup of COVID variants. To this day, we're still looking at China. We're waiting for China to finally open up. So demand has held back and the industry has responded in kind. We're still about 1 million barrels below production levels at this point. And until we see a rebound in demand, the industry will continue to play it cautious.
Okay, got it. Let me move on to something that undoubtedly some of our viewers will have seen in the headlines and you see it in the journal and so on. And that's the sanction situation, these price caps on Russian oil, potential refined product sanctions and so on. Is this kind of political theater or is this an important factor for investors to consider when they're kind of looking at their price outlook and where they want to invest in the space?
Well, it certainly is political theater. Keep in mind that the price caps, what are they? They are an absolute gift to India and China, two countries that never stopped, will never stop buying Russian crude oil, and will continue on this price cap. What it has done, it has given them a tremendous level of negotiation. So even during the start of Ukraine, before the price caps, China and India, imagine this, Russian oil from Western companies was verboten. Therefore, the Russians had to sell their oil to the only people who were willing to buy it, mainly China and India. So now you're giving these two countries even greater negotiating power with this price cap, and they are getting below market value oil, and they will continue to get that to the point now where China in 2023 has announced it is raising its oil import quota by over 20%, so 1/5. So China recognizes the gift that's being given to them, and they are going to take advantage of this. So it might sound good, it might play well for political theater, but at the end of the day, it's going to have a de minimis impact on Russian finances.
Got it. Okay. Let's shift over a little bit to the U.S. and the domestic sector. You had an interview on Fox Business where you talked about some of what the big oil was saying about their production plans and how much they were going to be investing in to boost output. And I was wondering if you could talk a little bit more about that, what impact you think that's going to have here on domestic production and by extension, the outlook for domestic producers.
Namely, it's going to be, and the broader picture, Mike, it's going to be bullish for oil investments, pretty dangerous for natural gas because there is a bifurcated market here. The bulk of natural gas, we'll start there, the bulk of natural gas production comes out of the Appalachian Basin. So Pennsylvania, Eastern West Virginia, Eastern Ohio, excuse me, Northern West Virginia. But the second largest producer is in West Texas, where they don't have the infrastructure to take advantage of it. So what we have here is you have whole hog with oil production. And to your point, Chevron, Exxon, BP have all announced significant increases in CapEx to get this oil out of the ground.
Yeah.
More oil you get out of the ground in West Texas, a byproduct that comes up with that is natural gas. So even though they're not drilling for natural gas, they're going to put a tremendous amount of natural gas back onto the market. Now, this is a concern, of course, because right now we're looking at a U.S. domestic market, the export market of natural gas, LNG, which is already at max capacity and actually has been hampered since June because a major export facility, Freeport LNG, had an accident and it has been shut down. So you're looking at demand for natural gas essentially being capped from the LNG. And then, of course, we have the fears of recession. Couple that with increased production, increased CapEx to take advantage of oil, and you have a situation where your investments are probably better in the oil side of the complex than the natural gas side at this point.
Got it. Got it. That's great. Great insights there. One thing that I'd also want to talk about, again, energy investing in general. I mean, obviously, it was one of the few bright spots in 2022. The sector dramatically outperformed the S&P and other component sectors. I mean, it wasn't even close, right? So I guess, what is your outlook here? It's early 2023. With all the big picture thoughts that you shared, how do you think this year is going to be for energy investors overall?
I think it will be a good year given the CapEx. My one big caveat here is the fear of recession. I'm certainly in the camp that we have been in recession. Of course, we had back-to-back quarters of negative GDP prints, which since 1947 has been the official or the unofficial arbiter of, yes, we are in recession, but somehow we talked ourselves not being in recession. But when we look at the inflation, and inflation is not going anywhere, where inflation is really half the story is energy, but the other half, just as important, actually more important, is food, right? Yeah. We can curtail our consumption of energy. We could drive less, we could put a sweater on in the winter, so forth. We can't curtail our eating. So, and this, by the way, is an offshoot, and I will talk about this at the Money Show. This is an offshoot of the industry's war, or the war against the industry on natural gas production. Natural gas being a main contributor to fertilizer prices. Yep. So my fear now is of course, going into a significant recession in the first half of this year. Therefore, if we see this, certainly this is going to impact consumption greatly. But I think in the aggregate over the year with CapEx, the industry has learned its lessons. I think, especially on the oil side, 2023 will be beneficial. 2024, when we get some more LNG exports, increase our capacity, that will be a great opportunity right now. But in the here and the now, Mike, it's on the oil side of production.
Got it. Well, those are great insights, Stephen. I don't want to take up too much of your time or steal too much of your thunder from New York. For anybody watching, I really hope you enjoyed this interview with Stephen. If you did, you're going to love seeing experts, including Stephen, in New York. You're going to get to ask questions you might have about their investing approach, interact with some of the smartest people in finance, and so on. So please click the link in the video description below if you want some more details about the Accredited Investor Symposium. And again, Stephen, thank you so much for your time.
Great to be here, Mike. See you soon.